CNBC TV 18, celebrating 15 years of leadership.
The European Central Bank will buy 60 billion euros worth of bonds from banks each month until the end of September 2016 or even longer in what is called quantitative easing. Quantitative easing in theory increases the supply of money, something that keeps interest rates low and encourages borrowing and therefore spending. Here's how it works. The central bank creates money which will be used to buy bonds from financial institutions. This in turn will bring interest rates down and spur lending to businesses, thus helping people to borrow more. This in turn should enable people and businesses to spend more, boosting the overall economy. But what has been the record of recent quantitative easings in creating growth? The US Fed unleashed its third and biggest QE in September 2012. Well, the US growth in 2012 was 2.3%, in 2013 2.2%, and 2014 2.4%. Really not much growth. Japan unleashed its quantitative easing in April 2013 with the BOJ agreeing to add 60 to 70 trillion yen in a year. What's Japan's growth? Japan's GDP was 1.5% in 2013 and fell to 0.2% in 2014. Well, recent QEs have not created growth, but they have certainly ruffled the currency markets. From September 2012, when the US announced its QE3, up to May 2013, when the Fed decided to end QE, the dollar fell from 1.2 to the euro to 1.4 to the euro, a fall of about 15%. The yen in April 2013, when the QE was announced, was 93 to the dollar. Post its QE, it has fallen to 118 to the dollar, a fall of 25%. Clearly, QEs impact markets more than they impact the economy. To discuss the impact of the ECB's quantitative easing on the economy and on the markets, I have with me Manoj Pradhan, Global Emerging Markets Economist at Morgan Stanley, and in a bit, Ankit Gheedia, the Equity Derivatives Strategist at BNP Paribas, will also join us. Well, first, Manoj, let me start with you. Do you think there can be an economic impact at all in Europe because of the quantitative easing?
Well, I mean, they've already had a series of measures to increase the balance sheet and expand monetary policy impetus into the economy. Don't forget that we've had a series of LTROs and MROs which have pushed liquidity into the banking system. The banks then used part of that money to buy government bond yields. We had the very famous speech by Draghi which promised whatever it takes. And that together did bring down yields substantially. So this is not the first installment of QE. One of the concerns about the impact is whether it can further bring down yields, which we've seen it do. It's brought down the euro. But I think most importantly, it gives a very strong signal about monetary policy intentions. We call this kind of QE where the central bank balance sheet is expanded proactively as active QE, and that tends to give a pretty good signal about monetary policy intentions.
Yes, it did certainly reduce yields and practically pulled some of the potentially exiting nations back from the brink. But Manoj, did it really improve the economy? Only see Europe or Eurozone getting into near deflationary status and even near stagnation. Do you see any economic improvement because of this 1.14 trillion euros?
I mean, there will be an impact. How strong is questionable, because look, what's the basic role of monetary policy? The basic role of monetary policy is to try and smooth cycles out. It cannot change the structure of the economy. If you're trying to compare, say, the US economy to the European economy has significant structural hurdles. Part of the reason that it's going into a disinflationary and deflationary period is because some of these structural impediments have not been cleared. Monetary policy cannot clear them, but what it can do is it can try to anchor monetary policy and inflation expectations to a higher level. And if those inflation expectations are raised to a higher level, then deflation and debt deflation then becomes a slightly smaller problem. So it's not that you can solve the economy's problem, but you can give it cyclical momentum that can persist for a period of time. Now, what the economic impact will be depends on how far yields can go. And as I said, since yields have already moved down, the marginal impact on this might be more a signal that says, look, we will do pretty much everything that we can to make sure that inflation expectations move up. So yes, I think there will be an impact. How strong is frankly debatable, but keep in mind that as the QE announcement has come in, the growth story was already starting to lift. The PMIs have already come in stronger. I don't think we should be attributing this to QE, but it might be a happy coincidence that the impact on oil prices also brings economic growth a little bit better than most people expect.
Okay, what about the impact from the currency angle? We have seen, for instance, in Japan, the yen going all the way from 93 to 118, probably because, or largely because of Abenomics and quantitative easing. What do you think will be the impact on the euro? We have seen what a 3-tick move. Does euro get to 105 or even parity over the next 18 months?
I mean, that's more, the level you're talking about is more a question for our FX strategists. But I will say that exporting deflation has been a strategy that's been pursued by central banks over the last 5 years, and the ECB is no exception. The Bank of Japan is no exception. In fact, it was the US that started doing it first. It's very hard to solve these deflationary problems at home because, as we've just discussed, they contain many structural elements to that. But trying to export some of them is not something that's unheard of. In fact, the opposite has been going on the US side with a stronger US dollar, and in fact the renminbi going along with it. Both those economies have been importing deflation. The ECB, I think, has engineered a program that will help them to export some of that deflation. And in that sense, again, the point of the euro is to try and manage inflation expectations, to try and push some of those deflationary pressures out. And to the extent that we do see from our FX strategy point of view, we do see the euro downside remaining in place for a while, because European banks will start lending out outside of the euro area. I think that's a move that can be sustained. If not, I think there will be pressure on the central bank to do something again.
Okay. Do you think that this very strong signal from the central bank at least papers over any exit fears? After all, we have this huge anti-austerity move coming in from Greece through its elections. Do you think these political problems will be now papered over literally with more euros?
Look, I don't think these programs are meant to address political issues. I think what we've seen from the Fed and the BOJ and now the ECB have been responses to economic problems. They have been responses to disinflationary pressures and deflationary pressures, which at a very fundamental level challenges the mandate of the central banks. And that's why these monetary policy makers are responding. Whether it helps to alleviate some of the pressure, well, it affects financial markets. It lifts asset prices. It tries to give an impetus to economic growth, and to that extent it does alleviate some of the economic problems, but I don't think these things are meant to look at political problems. Will it ease conditions for the euro area? Yes, of course it does, and to that extent it helps.
All right. Yes, I guess for the eurozone will have to separately negotiate with Greece if there is a huge opposition from the anti-austerity party. But Manoj, how should the global economy read this event? Are we likely to see maybe such a strong dollar that the Fed will be forced to push back its hiking timetable?
I think to some extent you're already seeing some of that happening. I mean, at Morgan Stanley, we've been looking at the Fed hikes starting not before 2016 for quite a while now, and things have obviously moved to do that. Two of the things that have helped to reinforce that view, number one, is there's a huge decline in oil prices, which has brought deflation into the US again, and it's very difficult for the central bank to figure out whether the deflation is coming purely because of oil prices, whether it's coming because economic growth from November has slowed down, or because the dollar has been stronger and the US has been importing deflation and probably some weakness in growth as well. And to that extent, if you look at market pricing of when the Fed is supposed to hike rates, that has already moved down to October from July, which is a move, and we think it has further to go to start in January. The thing to look out from a dollar strength and from a global point of view is, yes, this does help to the extent that our expectations about ECB policy and ECB-led interest rates have now been pushed lower. We've seen global yield curves all move down lower. But ultimately, what does this do to the dollar? Well, it probably pushes more capital into the US economy, probably strengthens the dollar, and possibly means a little bit more upside for economic growth over there. So I don't think this fundamentally changes the picture, and we would argue that it is ultimately the Fed that sets interest rates, even though the ECB and the BOJ can help temper some of those increases.
Okay, let me give you a blank check kind of question rather than throw leading questions at you. As an economist, a global emerging market economist, what of your forecasts have changed because of this 1.14 trillion of euros that will get printed?
Well, it does help. It helps in two ways. Number one, it helps because it brings U.S. interest rates lower, because you tend to push, as I said, capital into the U.S. economy. 10-year yields have already been low there, but they tend to get pushed down a little bit lower. Second point is when you're exporting more of this deflation, the U.S. will import some more of it. So as you yourself said, that will tend to push the Fed into hiking rates a little bit later. Again, turns out to be a little bit more supportive. And it does two things for EM. It actually helps emerging markets to have more time on their hands to carry out their rebalancing process. There are some very important processes going on in Russia, going to start in Brazil. India is on an early part of an expansion cycle. And all these economies then tend to receive a little bit more cheap capital. But we do have to be mindful that this does not release the economies that have a rebalancing process to do from their commitments. I think what that means is, as the interest rates get pushed down, if U.S. economic growth comes up stronger, then the higher interest rates and a stronger U.S. dollar will actually mean the downside could materially move up much faster. So we are getting, in a sense, a little bit more complacent as well, while we accept help from the ECB and from the Fed.
Well, one final quick question, since I have you, it's not connected to ECB really, but when do you see this inflection point in Indian economic growth? We don't see it in corporate numbers, we don't see it in the industrial output index. When do you see it coming up?
I'm not really sure that there's going to be a massive inflection point or any of the like. I think what we're likely to see is a slow move up in production. Yes, it will come. I think we're probably closer to it than many might imagine. Probably a couple of quarters, and you'll start seeing numbers that really do look like we're on the path of a recovery. But I think what we're seeing very solidly is that there is a significant desire to invest in India. In fact, when we talk to clients, they are only surprised when you talk, or if you do talk, of a negative story, which we don't have on India. So the sentiment about India has turned quite a lot. This seems to be a very slow-moving process. It's the FDI, it's the flows into India that will slowly start incentivizing better production. But don't forget, the sentiment at home also has to change among the corporate sector for that to happen. And as of now, what we see is a lot of concern that really there are no big bang reforms, when our argument has been that India doesn't need big bang reforms. The level you're starting from, the capital stock, the technology embedded in that capital stock is so low that just physical capital accumulation through an efficient administration is enough to drive your trend growth up. Frankly, Latha, I would be quite worried if you had seen a strong inflection point in IP and growth and all of those indicators and credit right now. That is not what we need. If you want a sustainable boom to last many years, you want to see a slow and steady story. You do not want to see a rapid expansion in economic output or consumption right now.
Okay, everything you said is music to Indian ears. Manoj, Pradhan, we appreciate you taking time out for us. Thank you very much for joining us today. We'll take a break on that note. Thereafter, we will be speaking with Ankit Gheedia, the equity strategist from BNP Paribas, on the same theme, impact of the ECB quantitative easing on global financial markets.
CNBC TV 18, celebrating 15 years of leadership.